No risk, no reward. But there's many different ways to define risk, Peter. What's your personal way of looking at it? Is it volatility, so just simply the swings up and down? Is it drawdowns, which is the amount you're off an all-time high, which is happening very frequently if you're an equity investor? Or is it this idea of permanent loss, like
Right. I mean, it's a great,
crystallizing that loss?
yeah. I
Everyone
mean,
has a different. What's your view on risk?
that's a great distinction here. So there are some things you invest in them, there's a risk of total loss. So a lot of different cryptocurrencies, we know that 99% of them already have gone to zero, risk of total loss. NFTs, risk of total loss, and even individual stocks. Companies go bankrupt all the time, total loss. Enron, a famous example, Lehman Brothers, but there are hundreds and hundreds of these examples, and they happen every year. And then there's risk of volatility, just what we're experiencing now. Markets go down temporarily, and then at some point in the future, we don't know when it is, they recover. So if you're, say, an index-based investor, if you own the S&P 500, which represents large U.S. companies, well, the S&P 500 is not going to zero. We've had 100 plus corrections. They've all ended the same way with a total recovery and then on to new highs. We've had dozens of bear markets where the market goes down 20% or more, and then we have the market recover. So if you got a broad-based portfolio, you're talking about volatility risk. That's a very different, very, very different than risk of total loss, and should give an investor that's diversified comfort that they're going to get through these corrections.